Hello, everyone, and welcome to the North American Stop of Future of Dealmaking webinar series. My name is Bill Lane. I'm a director of sales here at SS&C Intralinks, and I will be your moderator today for the webinar. I'm joined by an esteemed panel of guests, which we'll get to some introductions in a moment. But what are we going to cover today? So in 2024, companies were playing a bit of the waiting game when it came to deal making. Whether it was uncertainty in geopolitics or waiting for central banks to revise interest rates or even inflationary concerns, folks were on the sidelines waiting for things to stabilize, and the rebound was not quite what everyone was expecting. So today, we've put that in the rear view, and we're looking forward to 2025 and what to expect in deal making this year. What are deal makers going to do? What are they going to pursue? What types of deals are they going to pursue? All of that will be covered today, as well as other things like AI and strategic technologies that will be used to help facilitate deal making. So without further ado, let's get started. And a few items of housekeeping, and we'll get to the introductions. We're looking forward to the webinar today, and we will have some Q&A at the end of the session. So feel free, audience, to type in your questions into the Q&A box, and we can take those towards the end of the session when we do a live Q&A with the panelists. So again, without further ado, I'm going to have our panel introduce themselves. And Richard, if you could start us off, that would be fine.
Sure thing. Hello, everyone. I'm Richard Lichtenstein. I'm an expert partner at Bain Company. I'm also our chief data officer for our private equity and investors business. Over the years, I've supported hundreds of deals as a Bain advisor. I lead our work around Gen AI and investing. So I spend most of my time these days working with funds on various topics related to AI, whether that's internal operations, how you can use AI to make yourself more efficient, or a lot of diligence work of, if we're looking at a new business, is Gen AI going to be good or bad for that business? And also portfolio work, looking at the portfolio companies and thinking about Gen AI strategy there. And a lot of is around exit. So, if you're going to exit a deal, how do you make sure that they're well positioned when someone who's diligencing them asks the AI question? So anyway, look forward to discussing. It's obviously a hot topic, and should be a fun panel.
Great, thanks. And Henry, over to you.
Sure. Thanks, Bill. And thanks SS&C for putting this on. Henry Hagenbuch here. I'm Senior Managing Director, Head of Mergers and Acquisitions at Lido Advisors. We're about depending on the day, $32 billion RIA. And I run the efforts on the inorganic growth side. And I've been doing that for a good chunk of my career in the wealth management space. And looking forward to talking all things deal making today. Thanks.
Excellent. And Eric, last but not least.
All right. Good afternoon, everybody. A pleasure to be here today. I'm Eric, former investment banker a long time ago, and then transitioned into in-house M&A and integration work. Did that for 7 years with AB InBev. Pretty interesting times with a lot of transactions, big and small. And since 2017, I've been doing that with Ferrero in a corporate development capacity as we start to ramp up in the North American confectionery market there, with a number of carve-outs to my name in that time frame. So happy to talk through experiences and go forward plans today. Thanks for having me.
Awesome. Well, a wealth of knowledge on the call today. So let's kick it off. And with the first question, we'll take a little bit of a look at 2024. So the first question, Eric, I'll direct this at you since you just finished your introduction. How would you sum up 2024 deal-making environment, and what's exciting you mostly about heading into 2025?
Great question. And I think my answers to both of those are actually linked a little bit, right? As we move out of a high interest rate environment, I think we're starting to see deal appetite increase, and also a little bit of a realization that, or at least an expectation perhaps, that the decline in borrowing rates that we've seen may not continue to go down short term. So I think that's putting a lot of interest in capital towards the forefront of M&A. And I think it's creating conditions such that in 2025, I would expect to see substantially more activity than in 2024. And my remit will represent that, I expect, as well.
Great, Eric. And And to expand upon that slightly, in your role, where do you see the greatest opportunity?
Yeah, so a great question. It's a little bit specific, of course, to my employer. What we are targeting strategic investments in a couple of spaces. One, it's a bit independent of things like macroeconomics necessarily, but more consumer behavior. As we see the impacts in the North American, Western European marketplace of people shifting towards healthier foods, better for you, even legislature, right? That I was making a lot of news in the US, especially in the past couple months. There's a lot of impetus to rebalance portfolios. And I think you're going to see that from Ferrero. You're also going to see that from a lot of the other leading consumer products companies. So I think that is going to lead to a lot of M&A activity, perhaps on the smaller scale, as those large enterprises buy assets that are going to rebalance their portfolio and give them headways into new channels. That will definitely be a theme that I expect to play out. More specifically to Ferrero and to my work, we are primarily a European company, now 3 billion in the US, so we're starting to scale up well. But that remains a strategic priority that is open to the marketplace. And I would expect aggressive activity on the geographic standpoint as well, not just portfolio rebalance.
Yep. Well, I still love a sweet snack. So looking forward to your work. And Henry, I'll ask you the same question. So how would you sum up 2024 deal making for yourself, and what are you looking forward to in 2025?
Yeah, thanks, Bill. No, it's a good question. I think sector specific for me in the wealth management industry. I mean, 2024, I think, was an M&A record, for us. And despite all the consolidation, I think our industry is actually growing based on the number of new advisors entering the space. So, while there is, still ripe for consolidation, the fragmentation is growing from that perspective. I think if you look at it big picture, though, from a flow of funds standpoint, capital is very meaningfully coming into the space, predominantly from private equity, but now you're even seeing sovereign wealth funds get involved, venture capital. So I don't think the pace and interest will necessarily wane in the foreseeable future. I think in this day and age, there are a number of different acquisition models, qualitative reasons for why someone will join a particular firm or platform. And I think as long as that, continues to remain, this industry will continue to be a robust and healthy market for M&A.
Excellent. Well, thank you for that. And Richard, since this question kind of sets the scene for our discussion today, how about yourself? Is there anything you'd like to add from your point of view? Kid, he can't hear you, Richard. Oh, there you go.
Can you hear me now?
Yep.
Okay, sorry. Okay. As you gathered, my beat these days is around Gen AI. So that's sort of where I think I spend a lot of my time thinking. I mean, if I look back at 2024, I do think that one of, obviously AI was a big theme. And I mean, we done some surveys of investors, and I think we found that like 70% of investors like at least killed at least one deal because of Gen AI. And likewise, I think like 80% of investors got more excited about a deal because of AI, right? So like these are common topics. I think what I see for 25 on the AI side is, it's going to be a growing, sort of table stakes question on a new deal of, how are they thinking about AI? What are they doing about it? How are they thinking about the opportunities? How are they thinking about pricing? All the sorts of questions will become more common. But I also think that funds will be more comfortable starting to underwrite some of that opportunity, right? And we'll start to see, oh, well, I've now had at least a couple of assets where we've done Gen AI stuff and it started to work. And so therefore I'm more willing to lean out an asset that seems like it has opportunity. So I think from that standpoint, there'll be themes there. I mean, obviously I hope that we see a lot of deal activity in 25. Like I want to share the optimistic sentiments of my fellow panelists here and hope for the best. And I hope, I see the same signs they do and hope it all looks good.
Excellent. Well, thank you all for kicking us off with that question. So I'll ask Henry a question, right? And I think this is a topic that is top of mind probably for our audience as well, coming from 2024 in an industry that did pretty well in M&A. And it's about financing conditions, right? As we look towards to 2025, how do you think financing is going to change within the next 12 months within the deal making space?
Yeah, no, I think it's an interesting question. I mean, maybe exogenous events in the market could potentially derail or delay, the M&A in this space. But even then, though, I think, buyers look at that opportunistically. I think, again, harping on the variant acquisition models that I mentioned, I mean, buyers can also get quite creative around catch-up provisions and earnouts. So, I think you'll see buyers, structure deals around market events from that perspective. So it's kind of a nothing burger, at least in this industry, from that standpoint.
Great. And Eric, from your lens, from a corporate perspective, in terms of financing, how are you all viewing this year, and what improvements are you looking to see to help foster deal making?
Great question. I think I would have a more fruitful answer if we took it in context of my last employer, AB InBev, right? Where they have a very heavy debt load. Leverage is a huge part of their M&A strategy. And I think what you're going to see for players in that condition is that they're going to opportunistically try to rebalance their debt portfolio, right? As rates have come down in the past couple of years. And likely be returning to the market to try to deploy new capital at those lower leverage rates. Ferrero, on the other hand, has a pretty unique circumstance where it's one shareholder business, very high cash flow, right? Mm-hmm. And most of the M&A that we execute is, call it $2.5 billion at a time or less. And believe it or not, a lot of that is actually cash often, due to the capitalization of our business and the person's strategy in the Ferrero family. So yeah, a little bit of a tale of two cities there, but I hope that is elaborative of theory versus the practical reality for me today.
Yeah, no, I think it's good for, right, the market and the audience to be aware there are deals happening on both sides of this, right? We hear in the news all the time, and the market is tied to, all right, well, financing improved, right? But deals are still getting done in specific areas, right, on a cash basis, right? So both of those things are happening and will continue to do so. So Richard, I want to just point a question towards your way. Given you look across multiple industries and sectors, and maybe focused across a lot of clients in your current role, what industries and sectors do you see having the most potential for growth in 2025?
Yeah, it's a great question. I mean, I think that, tech obviously is a sector which, and particularly B2B tech is a sector that's, grown in importance in terms of private equity deal making. I see that, frankly, continuing, and which is a boring answer, but I see that continuing. I think that, software is obviously gets bigger and bigger. I think with Gen AI, software will be able to do more, and you'll see a lot more software assets that are thinking about how they can deliver value to their customers in different ways, which potentially makes them exciting. I think that, healthcare also continues to be a big sector, and I think will be. I think it's a sector where there's tons of innovation and new things and continued, penetration curves for many types of products that make them still attractive. And so, I think those are sectors where I see a lot of, where at least I feel like the majority, a lot of the calls that I'm on seem to be heading. And I guess the other one I would just say is like information services and services businesses and business services in general also remains a hot topic. I think, again, AI makes it an even hotter topic because there's a question of like any business that has a bunch of people running around in it. There's now a question of like, could AI make those people not make them go away, but make them, 20% or 30% more productive, right? And does that, does that create an opportunity? And so I do see continue, maybe slight uptick in the number of sort of services type businesses that I've been talking about recently. But, I get the answer because I feel like the mix in 25 is going to look that different from the mix in 24, I guess is what I'm saying. So it's not that exciting.
That's an okay answer, and consistency is okay if we think that's where it's going to be. Um, you know, going off of your answer, right? I'm going to pose this to Eric and Henry, who are specific within industries, right? So, obviously, I hope they're probably feeling positive about their own industries and sectors. But and we'll go to Henry first. What is the biggest risk within the wealth management space that you are all looking at this year or being aware of?
It's a good question. I think, I could be specific to my firm and how we think about M&A, where we care about culture and alignment, and we're not willing to compromise that just for growth. So, when we think about mergers and acquisitions, we want to look at the human capital that's come into play. And so we take a very concerted approach to that when it relates to ensuring that they're the right partners that are joining the firm, and that, they can be 1 + 1 greater than 2, as the old adage goes, et cetera. And so, I think it's a lot easier to screw that up than it is to, keep keep the compass pointed north, et cetera. And so, that's ultimately kind of the biggest risk that we look at, is just making sure that we're staying true to our approach, and, being a lot more selective and qualitatively driven from that perspective.
Excellent. Makes a lot of sense. And Eric, in your role, what's the biggest risk you see in getting deals done in 2025?
I think it's a interesting response to that question, in that I don't know how much difficulty there is in getting deals done, so much as there's challenges in sourcing or creating the right opportunities for deals in the first place. And I would tie that back to my previous comment about consumer shifting. And we operate in an environment now where most CPG leaders are very large, right? Well, we all interact with on a day-to-day basis. So to change the composition of those portfolios requires large acquisitions, integrations, et cetera, right? Or to greenfield a smaller one. And I think the reality of the situation is that the consumer preferences are shifting so fast that it's more smaller companies or even startup innovations that are able to meet that need. And as a byproduct of that, they're not large enough to really change the composition overnight. So I think that is the challenge in the M&A marketplace that I'm seeing, is not so much the capability to get deals done, because I think the balance sheets are pretty healthy for the larger CPG players. It's the availability of meaningful targets.
Excellent. Yeah, good answer. Specific to each industry, but makes a lot of sense. So I want to shift topics slightly into, away from the total of deal making in 2025, and think about AI, right? It's a hot topic. We've got Richard here who is dealing with generative AI every single day. And I want to start with a question, and I'd love to get an answer from each of you. And Richard, maybe we can start to you. How are you using, AI, or how are you seeing AI used within the deal making process? Whether that's due diligence, sourcing, document review, whatever it might be. Where are you seeing AI come into play?
Yeah, I mean, that's a great question. I will try not to give the half an hour long answer that I'm sure I could give if you really wanted to hear it. Look, I think a lot of funds are still sort of experimenting with different ways that they can take advantage of the tools. I think that the place where the sort of building block starting point is, these tools are really good at summarizing documents, right? At searching and summarizing documents. That's like the most basic thing that you can do with this stuff. And so I think many funds will do the basics, which is they have a ChatGPT enterprise subscription. They build some custom GPTs to automate specific workflows that they do a lot, and they start to use those. So that could be, next time when I get a SIM, I have some tool, I have a custom GPT, I put the SIM in it, and it has, the set of criteria, the set of cuts that it does on a SIM that are for my fund specifically, and, the kinds of things that I care about. And then, when I go to them, and it will then prepare a set of management questions based on that SIM. So when I have a first question conversation with management. I've got a draft already of what I'm going to go say to ask them about. Or, I can do a quick sort of red flag check on the sim. And if there's like a bunch of stuff in it that doesn't feel like it's a fit for my fund, I can just not go further and find another sim, right? So like those are sort of the ways I think funds are using it today. I think where funds want to get to in the next year is a little more advanced. I think on sourcing, a lot of funds today, they might look at 20 deals before they decide there's one they want to go deeper on. And obviously that ratio will vary a lot depending on who you are, but something like that. I think there's a question of like, well, does Gen AI mean we can make that instead of us spending a day on those 20 deals we don't go forward with? Could we spend like 3 hours, right? Or, half a day or like much less time, right? And so then does that mean we can look at 50 deals before we pick one to go on? And therefore like be more selective and like have a higher percentage of deals that actually go through or a higher percentage of deals that were that make it through IC and so forth. Like, I think that makes a lot of sense. I think that's a great use case. And the most advanced funds are starting to build tools where you can type in a company and it will start checking it against a bunch of things and running some of that analysis. And then I think the other piece is on the end of the journey of like, how do we make the sort of production process at the end of a deal easier? So how do we start drafting components of the IC memo automatically, summarizing all the different reports we get? Can we respond to LP questionnaires in a more automated way? Because that can obviously be very tight and obviously is important. So that's the other aspect of like, how can we sort of, make some of those production challenges faster? I think those are, and I think there's some progress on that as well. But again, I think most companies are still experimenting with custom GPTs and starting to use those and starting to see some productivity gains.
Great answer. And no, I'm still wrapping my head around it and how I can use it in my life. So hopefully I'll get there. And Henry, for you in deal making, have you all brought AI into your process yet? Or is that something you're looking to do?
Yeah, I mean, I think, it's an extension to the tools and technology that we use for business development and, growth from that perspective. I think, you're starting to see much more proliferation in our industry as far as that's concerned, trying to kind of have, even kind of a little bit of predictive analytics as far as around certain profiles and how, people with similar profiles and arcs in their career think about, strategic alternatives. And so it's a little bit of like, okay, we kind of get in front of that a little bit and see where that's headed in order to try and anticipate. So it's getting there slowly but surely. But I still think that there is some runway ahead of us to be able to really use it, and implement it in kind of a meaningful, way. But I think a lot of it is about data and the analytics around that and kind of taking advantage.
Okay, great. And Eric, how about in your space? Is there anywhere within the deal making process you're currently using AI or would like to?
Yeah, I would. My sentiments are very much in line with the previous answer, right? I think we're in the early innings of learning how to implement this most effectively for M&A. The earliest applications that I've seen are using it to help through due diligence and to sift through larger data rooms, right? To speed up the process of going through some pretty mundane activities that need to be done. So we are leveraging AI to do that. That's the more basic and tactile frontier. I think when you start looking at strategy, growth plans, et cetera, that might be something that's more of a future, application for AI.
Excellent. Makes a lot of sense. A lot of work to be done. And Eric, since you're on my question, and for the audience and whoever wants to chime in here, when you're looking at a target, for example, how are you weighing AI within that company? How are you viewing its risks and synergies to its business? If a company is using that heavily, and how does AI fit into your selection criteria now?
Yeah. Currently, I would say that is not a critical component of our selection criteria. I do think that's going to increase going forward, right? Because the more that companies, even in sleepier sector like CPG, are able to effectively leverage AI, it's going to allow them to be more efficient and more proactive in meeting consumer trends where they're going, right? Which leads to innovation, which leads to the health of the business. So I think it's going to be of increasing importance, but today I don't think that that's a major differentiator in M&A selection process.
Yeah. In
Richard, that I would.
yeah, come on.
I was just going to jump in. What I would say from the wealth management space on that one. It's exciting to kind of see, where the potential is, but I think on kind of a fundamental basis, because it is a relationship driven industry inherently. In some simple forms, for example, I know certain video tech platforms and stuff are being able to add kind of like an AI note taking component, for example. And so, the great benefit there is, everybody knows how challenging it can be to be, really engaged in communication or in a conversation with somebody while also taking a copious amount of notes. And so if you have that AI feature to be able to kind of hold your hand through that process, well, then you can effectively kill two birds with one stone. And chances are the AI note taker has done a lot better job than if you were to do it yourself. Right. And so there are some kind of incremental added benefits that you're starting to see there. I've also seen it in ways where certain, platforms are using it to help kind of create icebreaker opportunities for you when you're looking at somebody's bio, where they can, Venn diagram their respective bio with yours or vice versa, and kind of give you examples of ways in which that, you can kind of have a deeper relationship, a deeper connection with those types of advisory firms. So.
Interesting. Yeah. I know I've benefited from that note taking as a salesperson many times, right? And it can keep your eyes forward so you're not looking down at the pen or typing. And Richard, from your lens, when you're helping clients think about deals in AI, what type of risks does AI introduce into kind of the selection process or deal making process?
Yeah, well, I mean, sorry, do you mean in terms of like as you're thinking about an asset and you want to think about, is Gen AI going to be a problem for this asset?
So yeah, happy to clarify. What I'm thinking about is if you're thinking about an asset that, looking to purchase, right? And how is that company's exposure to AI? How are you looking at it from a diligence perspective, right? If
Yeah.
companies, are they early? Are they not adopting, or are they heavily adopted, right? Where are the risks in that?
Yeah. So, okay, again, I will try to give a relatively short answer. We have a criteria that we've developed at Bain. We've now used on about 1,000 companies. So, I mean, I think we feel like it works reasonably well. The basic way we like to think about it is, you start with, is the thing that the company does something that Gen AI can do pretty well, right? Like the classic example of this, of course, is like Chegg, right? Which is a company where like basically their function of at least the task they did of summarizing books for students who want to not read the books is now something that, AI can do really well. I think that for, and so we don't see too many businesses like that, maybe like 5% of business we look at, there's a real risk that Gen AI can just do what the business does. So we look, then you want to think about, sort of second level effects, right? So will AI enable new companies to enter the space and compete with them? Does that break down barriers? That can be things like, companies I've looked at where their core strength is, we've ingested tons of rules and regulations and things, and we make it easy for people to understand those or query those. Like, well, Gen AI can also do that pretty well, right? And so that may not be as sustainable an advantage going forward. Or, this, we deal with super messy data and we had to build all these complicated algorithms to process it and deal with it. And so that's our strength. And like, does that get easier, right? And that moat goes away and more people enter. So you want to think about that. You want to also just think about, is Gen AI going to create meaningful productivity boosts, which can be good, obviously, if you're providing that, but also how is that going to change market dynamics? So like my favorite example is, if you have software for lawyers, that's like hours tracking software, right? And, you're charging per seat. And then in the future, maybe law firms won't need as many paralegals because some of the work they've done gets they do get done by Gen AI, like your hours tracking business might be impaired because you can't sell as many seats. Like that's, you want to think about that, right? And before that happens, right? And how you're going to deal with it. So those kinds of issues. And then the plus side, we look at, can Gen AI make the product better, right? Like, is Gen AI going to make it more valuable to more customers? Is Gen AI going to enable you to enter new markets that you couldn't enter? Is it going to allow you to embed more deeply into systems, do all the things that make products better? If so, that's good. And then the last thing you want to think about is, can Gen AI make your business more productive, right? If you have a big call center operation, Gen AI is going to be a big help. If you have a lot of sales people, if you have a big inside sales team, Gen AI can help, right? If you have a lot of developers, and so forth. And so are there big pools of knowledge work at this target company where Gen AI can make it more productive, right? And usually that's going to be a good thing. Obviously, if you're pricing per hour, then you'll want to think about how that all plays out. But that's sort of, so those are sort of in a quick rundown, the types of things to think about. As I say, only about 5% of companies do we look at and say, yikes. Most of the time we look at it and say, there's probably some opportunity here from Gen AI that's real in the last two categories, but there may also be some new threats. And so this is probably an issue that should be of high salience to the executive team. And if the executive team is paying close attention to it and working on it, you can feel good. And if they're not, then you may want to think about that if you do the deal.
Yep. Okay. Thank you for that. So shifting out of the AI lens for a moment here, and I'm happy we covered that and covered it well. I want to get into, and when we kicked off today, I mentioned 2024, there were geopolitical concerns, economic concerns, inflation, global tensions, higher interest rates that were coming down. I want to talk about a little bit about that right now, right? I think that's top of mind. New administrations, many elections happened in 2024. So Eric, I'll direct this to you first, right? How do you anticipate these geopolitical economic factors, right, that I listed, impacting deal making in 2025?
Great question. And I think that I would have three responses to that, right? What is obvious? Geopolitical tensions and a lot of the items in the news that are happening can dramatically impact interest rates, which drives all sorts of strategic challenge, right? But more drilling down one layer further than that very high level comment, I think the risk of tariffs is something that may actually become a driver of M&A, right? As we see the risk of these tariffs propping up all over the world. If you take my employer as an example, a business that imports and ships overseas enormous amounts of product all the time may be incentivized to onshore operations in certain countries, which could drive M&A through a strategic lens. And then the third piece is, I suppose, specific to the US, but you see it in Western Europe as well, right? New legislature or new ways of working around healthcare and labeling, transparency about composition of products is something that will link to my previous comments about needing to shift portfolios to more healthy products, which will lead to more M&A as well. So I view those as challenges, but outside of interest rates, I think they're actually challenges that are more likely to drive more M&A than less.
Yeah. So challenges that can become opportunities in certain ways. Excellent answer. And Henry, how about yourself? Are you how are you seeing these factors play into your role in 2025 in deal making in your space?
Yeah, I mean, I think again, there's always going to be buyer opportunity, and I think what they'll do is they'll create a market and a deal structure and an environment for sellers that alleviates some of their concern around some of these risks inherently, right? And so, whether that's getting cued on the deal structure aspects, but also, again, and I mentioned it earlier, it's a relationship driven industry, right? And so, the actual asset that you're acquiring is the relationship between the advisor and the clients in my world. And so, you have to ensure that there is peace of mind and that you're not disrupting the apple cart from that perspective. So, if there is, a level of concern because of certain tensions or events or geopolitical issues, that you have to be cognizant of that, and you have to make sure that you're handling them the right way. Because I think, the M&A that occurs in this industry is, it's a lot of a lift. There's a lot of misconception that it's just kind of like, oh, we'll just mindlessly aggregate assets and kind of bolt on here and there. But I think a lot of the work is done, after the acquisition is consummated, right? Where with the integration and the transition and ensuring that, you can try and enhance and optimize the client experience for those advisors. So, I think you have to be cognizant all up and down from that perspective. And I think there's a lot of inconsistencies in the market right now in general, and so, it's kind of everybody's guess as far as where inflation is going to go, GDP forecasts, geopolitical events, et cetera. So, yeah, it's, but I think the M&A in my space will continue to soldier on pretty opportunistically nonetheless. Well, I think we lost your audio, Bill.
That, folks. One thing I want to piggyback off your answer there quickly, and hopefully, it is about integration, right? Do you see any of these factors playing, to get the deal done? Maybe they play a role, right? But with integration, is there anything that these factors impact, in your industry?
As far as what specifically?
Just curious, right? When you look at integration, right? Oftentimes we talk about getting the deal done, but I've being in this business a little while, we forget about integration sometimes, right? Deal's done. We certain parties wipe their hands, they move on to the next one. I guess I'll rephrase this. What risks within integration do you see in 2025? Is there anything new that you all are looking out for, right? And I know you're specific on your industry, relationships really matter. Is there anything in terms of risks that have come about in the last 12 months or you're looking forward to?
I think for us specifically at my firm, we're pretty qualitatively driven. So I think as long as we retain that focus, and I think tamper and ensure that we don't kind of get too far out of our skis and really kind of focus on making sure that integration is solid and that our new partners are, invigorated and excited for this prospect. And a lot of that comes through how, their clients are reacting to it. Right. And so, I think that's a big driving force for us. We're always very cognizant of our culture and the alignment and how we think about it from that perspective. And we don't want to compromise that. So I think if we can continue to ensure that that's our North Star, then, I don't think we just, one thing I will say though, is about integration is we learn every single successive acquisition about something. Yeah. And as my dad likes to say, you aim for a high average. And so we hope that, you come across things that can improve the process, can improve the approach and the structure. And so, for us, it's a matter of not being some sort of arcane institution that's set in their ways, but rather being kind of flexible and adaptable to, kind of new methodologies, et cetera.
Makes a ton of sense. Right. Learning a little piece incrementally each time you get a deal done and integrate makes a lot of sense. Add it to the playbook for next time. Is piggybacking off of geopolitical concerns, right? Being more specific on the public markets. Eric, I want to throw a question your way around this, right? We've seen IPOs of the public market kind of come back, a little bit, right? But be relatively frozen. Do you anticipate, seeing more companies go public in 2025? And if so, why?
Yeah, it's a good question. I do think the answer is yes. I think you will see more going public, but perhaps not by a dramatic degree. But I'm saying that based on a little bit of a backlog, right, of people trying to capture the right moment for valuations. And I think that there's good macroeconomic considerations to have waited perhaps last year and to believe that the conditions won't get materially better from more or less the current state going forward. So I think that creates a pocket of opportunity that will likely create a little bit of a pop in new listings. But I don't have much confidence in the degree, right, to which that will be true. And I do think that it will directionally.
Yep. Okay. Yeah, I'd have to agree with that, right? Will there be this massive spike, but it will go up, but not, a massive spike. So shifting to the private market then, right? And I'll ask this, or maybe we can answer this first is, in sector specific, how often are you all sourcing deals from, sponsored backed companies or looking at sponsored backed companies? Is that an avenue that you're going down often, or are you keeping a wide net?
Yeah, no, our deal flow is very robust.
Yeah.
And I think that it falls very much in line with what I was outlining in terms of the competitive dynamics of the space. We're seeing a lot of smaller or medium-sized businesses that are trying to capture that right time to sell in terms of macroeconomic conditions, also sector conditions, right, for confectionery and sweet packaged food. So we have a ton of activity, and we're actually buying things worldwide at a pretty fast clip to the point that it becomes like an integration challenge. So I think that our piece of the sector is going to be very active this year, right? And I think many of the people on this call have also seen that rebalancing is not, it might be primarily in terms of volume in the small to mid cap acquisitions, but not entirely, right? You have the Calanova work. There's been discussion in the news about Hershey potentially looking at a sale. So, I think that there is a ton of interest in aggressively trying to rebalance and capture market share given the current conditions on the market.
Okay. Right. And Richard, I'll pose this question to you, right? Because I know in your role, you're working heavily with private equity data, right? How are those sponsors viewing the market right now? We hear a lot about pent up sale demand, right? There's companies being held for a long time. X amount of percentage of, private equity firms have held to length essentially. What are you seeing in that space, and what's the word on the street?
Yeah, I mean, there's definitely, plenty of dry powder. So there is plenty of money that funds want to put to work. As you say, there are also plenty of assets that are at the point in their life cycle where they probably want to trade them. So in that sense, you have the ingredients for a robust deal market. I think the only real overhang is the interest rates, because even as interest rates are lower now than they were, they're still higher than they were when they bought those assets, right? And so you need to be able to, in order to get a deal done, right, you need to have things have to work out in terms of where the assets are. And so, I think what we saw last year is we saw a lot of, A assets come to market, right? And we saw that there's a lot of opportunity to get deals done around A assets. I think the question is, as the B assets come to market, what will there be as can they get the market done for that? I'm optimistic, and I think most of the people I talk to are as well. I think most people are at least cautiously optimistic that, the right ingredients exist for a frothier deal market this year. I think, it's still just a little bit early to tell. And so I don't want to, on a video with 100 people watching, make a super bold prediction about it. But it certainly feels like we're going to get a lot of, it feels like there's a lot of deals that need to get done in this market. And so I hope they will be this year, and I still think they should be. And I think if you ask the investors, they want to make them happen. They just have to it has to happen, right? And everybody wants that.
Yeah, right. Everyone wants it. We just need the right ingredients to get it right and the stars to align for things to come together. So we're about at 45 minutes here. We have a couple questions in the chat, and to the audience, if there's anything you want asked, feel free to type that into the chat, and we can ask that, right? So we'll take a couple of these and I'll direct them towards who they're supposed to go to. So Eric, you had one come in, right? And it's about, you've mentioned this a few times, or or kind of teased it right around how might cocoa prices impact your strategic M&A strategy this year?
Great question. Definitely something that's very much top of mind for us, right? As well as anybody else in the space. So there's a number of things that you can do to try to mitigate that risk, right? Outside of M&A, you can reformulate products. You can try to rebalance what you sell into the customers to lower your exposure. You can try to R&D your way out of it in the future, but none of those are as effective as rebalancing the portfolio itself, right? Which you can do most effectively and fastest through M&A. So that is absolutely something that is high on the agenda, to look at how can we lower that exposure. And again, you can enter new categories. You can look at companies that operate within that confectionery space, but with a lower cocoa content. And those are strategic imperatives that we have, and that anyone in that space is going to have, to try to protect the shape of the P&L, given that cocoa prices have increased 4 to 6x in the past couple of years. It's really been a seismic change. So good question, and one that M&A can certainly help address.
Yeah. Okay. Well, thank you for that answer. So, Richard, you had a question from the audience here around your attendance at an upcoming conference, and it's around really, what type of technologies do you see in the market, right? And what type of AI technologies are exciting to you within deal making?
Yeah, it's a great question, and thanks, Luke, for asking it. I will be back at DealMax in a couple of months, so if you want to hang out, and you're in Vegas in April, feel free to let me know. Yeah, so it's an interesting question, and so there are a lot of tools out there. I've played around personally with a lot of them. I think many of them are not fully ready for prime time. I think this set of technologies that I feel is the most mature for investors is the sort of knowledge management tools. These are tools where you can point them at your corpus of documents, of deals you've worked on, final presentations from consulting firms and other parties, as well as IC memos, et cetera, and be able to search them and get, pretty decent answers out of them, or as well as new content of, like, I have a new data room, like, take a look at this. There's progress, happening in these spaces. I think the couple of names, I'll just throw out a few names there that are, popular, like Rogo, Blue Flame, Sana, Hebia. Those are some of the big names in that space that I think have done, that are making progress and making a lot of updates and are sort of targeting investors with investor-centric products. Obviously, if you grab a beer with me in Vegas, I can give you more detail on specifics, but that's kind of what we're seeing. And again, we're working with funds closely that are implementing these. I think they're seeing them work pretty well. I think that they require some customization to truly get to a point where they can really accelerate productivity, but they're good enough that it's time to start playing with them. So I think if you're a fund and you're listening and you haven't started investigating those, I think that's probably like a very good concrete place to start. Just to give a place to something specific to go do anyway.
Yeah, no, a lot of good names there. Big ones in the space as well. So there's one more question within the chat here, and it's around valuation. So I'll open this up to the group if anyone feels inclined to answer. It's just about how much more room is there to grow with valuations, right? And does this impact just the private markets, or does it also impact the public markets? Does anyone want to take this one?
I mean, I can attempt to answer it. It's a very hard question, right? I mean,
It is.
I think so I think with valuations, at least on the private market side, I can speak to that. Public markets are harder. I mean, if we could all predict public markets well, we wouldn't be sitting on webinars. We'd be all sitting in, on our mansions, right? So it's hard to predict. But for private markets, I think, if you look at what's driven valuations historically, it's been a combination of an actual realized value, right? It's been a combination of multiple expansion, and top line growth. And then there's been a dream of getting a lot of margin improvement. And that's been underwritten in a lot of deals, but historically that actually hasn't been realized as effectively as people would like. It's not that obviously PE firms are very good at cutting costs, but what often happens is they successfully cut costs in one area, and then it turns out more investment is required in IT or in some other area, and that offset some of the benefits that they thought they'd get. So I think going forward, if we want to see valuations, sustained, we need to believe, I think, that you're going to get more of that margin that the margin improvement stuff is going to be real in the next time around, because I think multiple expansion is going to be hard to get given unless interest rates come down meaningfully in the next few years. And so it means you've got to believe you can actually deliver on some of the cost cutting opportunities. Now, of course, the good news is we now have AI, right? So we actually now have a huge new buzzsaw that we can take to cost cutting that didn't exist a few years ago, that actually makes it plausible that you could find cost cutting opportunities that, truly didn't exist during the previous ownership. So I think there's an opportunity to sustain at least current levels of valuation in PE on that basis of like thinking about real margin improvements being possible and so forth. But I think that's kind of I think I don't see I certainly don't see valuations at a multiple basis going up dramatically in the next, year or two, except in maybe specific cases where there's, a lot of buzz around, like, talking about foundational models or something.
Bill, I think GDP forecasts kind of show this kind of robust economic environment backdrop, right? And so while valuations, I think, are stretched and a little expensive, I think they're of higher quality, and certainly Mag 7 makes up a lot of that. But those guys in and of themselves have pretty strong ROEs. So, I think it's a matter of how you think about it. There's also somewhat of a normalizing yield curve at this point. So, it's, again, I mentioned inconsistencies in the market right now, but yeah, so, when you do find that crystal ball, though, whether it's Richard or Graham, let me know.
Yeah, I was going to say it's a tricky question. Everyone's searching for the answer, right? So in both markets, one more question just came in, and Richard, and for anyone, if anyone has experience with this, but it's around AI, specific. If there are any type of tools for web scraping, right? And I'm not quite sure what the use case is, right? But for lower middle market firms to scrape the web for maybe information or sourcing companies and deals.
Yeah, it's a great question. So, I wish I had like a fantastic answer for you. At Bain, we ended up buying a web scraping firm a few years ago, and we've now grown it quite a bit. And so we've just basically built our own web scraping set of tools, because we found that we couldn't find a commercial solution that was willing to work with us, and we do a ton of web scraping. I don't think that means you have to do that, but I'm just saying that's unfortunately my experience. What I will say is, I'm personally very excited about Operator and what that implies for future web scraping. So Operator is a new tool from OpenAI that they just released a week ago. I don't know, I'm not sure if any of you read my Substack, but I have a Substack called Artificial Investment, which I write about, and I had an article about Operator last week, so you're welcome to check that out if you want to read more. But the basic idea of Operator is you can give it a task, and it will go to a website and just do that task for you. Now today this version 1, it doesn't quite work well enough, I think, Michael, to like handle all your web scraping needs, but it could do some of it. But I think that like Operator 2.0 will probably be able to do a lot of that web scraping stuff for you really easily. Like you'll just be able to tell it, go to this website and pull this information for me, and it'll just kind of do it. Right. So I think that there's a lot of potential excitement there. If Michael, if you send me an email, I'm happy to like try to think about, ask my web scraping team for some specific recommendations to get back to you, because I don't have any names on the top of my head.
Yeah. Well, thank you, Richard. So we're about, at time here. So just want to thank the three of you, Richard, Henry, Eric, for a great panel today. We've covered a lot of information. about 2024, what we're looking forward to in 2025, the future of deal making. We got industry specific in certain ways. We tackled a bit of AI, which is always a tall order, but a really great conversation. So thank you to the three of you for joining us today for such a great panel. Thank you to the audience for joining us. And we look forward to seeing you again on another webinar, and have a great day.
Thanks, everyone.
Thank you, everyone.